Hi, everybody, and welcome back to video number 4 in Chapter 7. When we left off, we had just finished the LIFO method for periodic inventory. Now we'll look at it for perpetual inventory. And again, we do it row by row, and we will be selling, however, under LIFO from the bottom up. We'll be keeping inventory from the top down. Okay, so here's our transaction. Here we have beginning inventory. Here we have purchased 6,000 more units. So we'll bring this row down, bring this purchase across, just like we did with FIFO. But now when we sell these 4,000 units, we're going to sell from the bottom up. So we'll take all of that 4,000 units from the 6,000 units I'm showing you here, all at $4.40. That gives us cost of goods sold of $17,600. We're going to keep 2,000 from this row here. I'll get it in a minute. We're going to keep 2,000 from this row here, and we're going to keep in inventory 2,000 from this row and 2,000 from that row here as our inventory. Now when we purchase it, again, we're going to bring this row down, we'll bring this row down, we'll bring this purchase across and foot it all out, and that 26,300 will be our ending inventory. Again, 43,900 available, whether we sell it or keep it. The LIFO method is going to result in a different ending inventory and cost of goods sold amounts than the amounts calculated under the periodic method. As you see, there's the periodic method, and there is the perpetual inventory method. Okay, now as we look at a period of rising costs and we compare these, we will always find that the average cost falls between LIFO and FIFO here. So you can see sales is going to be the same in all three scenarios. Cost of goods sold will be different. LIFO is going to have the highest cost of goods sold in a period of rising costs, and FIFO will have the lowest. Consequently, FIFO's gross profit will be the best, and LIFO's gross profit will be the worst. And our operating expenses are a constant $5,000, and at income tax at 30% here, we find that the net income is best for FIFO, worst for LIFO, and average cost falls in between. Our inventory costs, therefore, are different as well on the balance sheet. So what that means is we can use FIFO for book and LIFO for tax, which a lot of companies do. LIFO minimizes your tax burden, and FIFO puts your best foot forward for what you show on your financial statements. And so the factors to consider then are typically whether we sell older goods first, the physical flow of goods. Grocery stores, for example, are always going to use FIFO. But I mean, in reality, the physical flow will always be that because they don't want to keep old product that's going to deteriorate with age. And you can read this on your own. You don't need me for this. But the income taxes, this is important. FIFO results in higher income taxes, higher tax payments if you pay income based on FIFO. Whereas the biggest advantage of LIFO is going to be the lower income taxes from and a true cost savings that you get from that by selling via LIFO. Okay, so the earnings impact in a period of rising costs, again, FIFO results in the highest reported net earnings, and LIFO report the lowest earnings. FIFO is going to have a disadvantage of matching revenues and costs, because what you're selling is from the top down. That's the oldest inventory. So that's the cheapest inventory in a period of rising costs. So I'll let you read these as well. And then inventory on the balance sheet. FIFO results in the disadvantage because inventory is more vulnerable to declines in value because that inventory is older. So in theory, LIFO might substantially minimize your write-downs if inventory values declines. So it's a tricky little scenario as to which one you want to take, but most companies that I know of anyway use FIFO for book and LIFO for tax. Here is Sherwin-Williams, and now we're going to look at the non-LIFO disclosure. The following table summarizes the extent to which the company's inventory uses the LIFO cost method, and it presents the effect on inventories had the company used a first in, first out FIFO inventory valuation. So here is the excess of FIFO over LIFO. Quite dramatic there. Okay, so now the Harper Company uses periodic inventory systems, periodic, and it has the following cost information. Here it is, period of rising costs, total costs. Compute the cost of goods for the month of June, June's ending inventory using average cost FIFO and LIFO. So we are going to do that under a periodic system. And here's our average cost. So we take all these units, we divide them into 16,200 here at $8.10, and then we value everything at $8.10. Pretty straightforward. Whoops. FIFO, we're going to, in a periodic method, we're going to go look at selling from the top down. So here there's their selling price, the total cost of goods sold, 9,100. We're going to keep from the bottom, June 25th and June 12th, 7,100. And so our available is still be 16,200, but our FIFO is going to be again sold from the top and kept from the bottom. So now under LIFO, we do it the opposite way of FIFO. We're going to sell from the bottom and keep from the top. So as you can see, we're keeping from the top here with ending inventory of 800 units, and we are selling from the bottom, the most expensive products here, and we get 10,300 under a periodic system. All right, we have some special issues related to LIFO. Many companies, in my experience, my companies use LIFO for tax and external financial reporting purposes. FIFO for and average cost, standard cost system for internal reporting system. Why? Because our pricing decisions, we want it based on what we're actually doing, which is FIFO. And record keeping is easier. The profit sharing bonus, LIFO, is troublesome for interim periods. So we have what's called a LIFO reserve. Important here. LIFO reserve is the difference between inventory method used for internal purposes and LIFO. So if Acme Boot Company uses FIFO for internal and LIFO for external reporting, here's the scenario. At January 1, 2025, the allowance to reduce inventory to the FIFO balance is $20,000. At December 31st, 2025, Acme's trial balance shows an inventory value of $850,000 under FIFO, while a LIFO inventory is $800,000. So, what is the journal entry to reduce inventory to LIFO? Well, what we're going to do, the difference between is $30,000 because we already had $20,000 at the beginning of the year, and this difference is $50,000. So we need an additional $30,000 here. So we're going to debit cost of goods sold and credit the allowance to reduce inventory to LIFO, sometimes just called LIFO reserve, for $30,000. Okay, so if I look at Caterpillar here is their note on inventory, stating they're going to state the inventories at the lower of cost or net realizable value. We know that. We principally determine cost using LIFO. So if FIFO method had been in use, the inventories would have been $2,132,000,000 as opposed to $2,086,000,000 higher than what was reported in the current and prior years, respectively. So the company should disclose either the LIFO reserve or the replacement cost of the inventory. Okay. Now, we'll take a look at that information we just went through about Caterpillar. And the company has current assets of $39,464,000,000, current liabilities of $25,717,000,000. So using that illustration, what is the Caterpillar's current ratio after adjusting for the LIFO reserve? So if we take these numbers here and here, and we simply come up with a current ratio of 1.5 using LIFO, that's pretty easy. But then if we adjust for the current ratio under FIFO, we'll just make the adjustments that we found over here, 2,132,000 here, and add that to the 39,434 here. And that comes out 1.6. Without the LIFO adjustment, Caterpillar's current ratio is understated. All right. So special issues related to LIFO. Older low-cost inventory is sold, resulting in lower cost of goods sold, higher net income, higher taxes. So the specific goods approach to costing LIFO inventory is often unrealistic for two reasons. One, the cost of tracking each inventory item is expensive. We're not going to do that. The erosion of LIFO inventory can easily occur. We call that LIFO liquidation, which often is going to distort net income and lead to substantial tax payments. Okay. And then the layers of LIFO inventory will illustrate. Here, we'll talk about that in video number 5. Until that time, bye for now.